Hello and welcome to Moneycontrol. You've tuned into Earning Express and I'm your host Nickey Mirchandani. Today we're here to talk about the energy efficiency solution company, Rishabh Instruments, which has suffered in the last two sessions. At least the stock has taken serious amount of drubbing, lost as much as more than a 20% after reporting in 53% decline in the net profit year on year for the quarter to a sum of around 7.61 crore. As against the number of nearly 16.5 crore, the margins have halved to 8.6% from 17.2% in the corresponding quarter. But what's the outlook going forward? What went behind the numbers? Let's find all the answers out from Dinesh Musalekar, who is the group CEO of the company. Well, morning there.
Good morning. Thank you for having me in this interview and giving me an opportunity to talk what's going behind the numbers.
So help us understand why have the margins halved? What can be expected going forward?
Yeah, I mean, if you look at, it's always expectation versus what has been delivered. I think what we really saw, this is kind of an assumption that the reaction which we see in the market is looking at Q3 against Q2 performances. But generally, we focus on annualized results, and we are absolutely in line with our guidelines which we had set for annualized results. So if you look at annualized numbers from last 9 months cumulative to this year's financial 9 months, our top line is about 30% growth. That means our company products and services are very much appreciated, and in spite of the slowdowns that you see in Europe and the rest of the world, of course India is thriving. We see that 30% top line growth. That means our company products are very much in demand. And looking at the bottom line at the EBITDA level, adjusted EBITDA, cumulatively 9 months last year to this year, we are up by 42%. So yes, the cumulative numbers of EBITDA was around 20% when we closed Q2. Q2 was pretty much strong for us. In relation to that, Q3 was relatively smaller, and there are reasons behind that to have those profits under stress. So these are basically coming from two major reasons. One is in aluminum die casting business, which has put a stress on the overall margins, which is about 40% of our business. So we introduced about half a dozen new very challenging projects. These are in the EV electrical vehicle segments, and all our customers who are the tier 2 customers, for them also these are absolutely new projects, very much innovative. So these are projects which will be running for 4 to 8 years. These are the contracts which we have signed, and the first year of launch of these projects are going to be really challenging because of it's unknown territory for most of us, including our customers. So a lot of changes in the designs, and you have to stabilize these projects. So they also work on innovative projects with the best of the companies. So to that extent, it's an investment that we are making in the future for the long term. As we always said, that we are a company which is good for mid-term to long-term investors, and this has been our guideline right from the beginning. So we are not really bothered or concerned about it. So at the moment we are 16% YTD EBITDA level, even though absolute numbers are up by 42%. So going forward, we expect a very strong Q4. Q4 is normally stronger. We have seen that in the past. So we will close with our commitment of 20 to 25% top line, which we said, and also with around 18% EBITDA, adjusted EBITDA, which I will sure will be there. So this is how the outlook is looking, because we have got so many different market, different segments. Every quarter, some markets will do better, some companies will do better. So it's always up and down, and it gets adjusted. So we have this overall view of annual numbers, and specifically talking about the projects which I spoke.
Dinesh, I will just want to interrupt you there for a minute. Allow me. I want to understand, you cited two reasons for your numbers going into single digit, the margin profile going into single digit. One, you suggested that there was this slowdown in Europe. That was one. And the other reason that you cited was some demand pressure also coming in for aluminium high pressures die casting business, which is 38.7% of your overall revenues. Have I got that right?
No, see, yeah, Europe is slowing down, but in spite of that, in the top line, we don't see any decline. So we are growing company by company. If you look at
so Europe contributes to 49.1% of your overall revenues. If Europe is slowing down, do you expect some amount of added pressure coming in this quarter itself, or you think this is just one of the seasonal weak quarter that one could look at?
See, there is a general economic slowdown in Europe, but our industry, in our company, we are not finding that. So the demand on the top line is all there. So there is no decline in any top line performance in Europe by our companies, or we don't see that coming in at least a few quarters more. But there is a pressure on the margins because of launching new projects in Europe. So these are new projects where these are new technologies where there are stabilization issues. So we have to stabilize these products. Until those stabilize, your cost of manufacturing for those projects is temporarily higher, and they will settle down in next 3 to 6 months time, maybe 9 months. So this is a period in which they will settle down. But this is only for the aluminum die casting side of the business. But the electronic side of the business, our margins are increasing substantially in Europe as well as in India and all the markets. So we absolutely have no issues on the margins as well as top line when it comes to electronic side of the business.
Yeah, because aluminium is relatively a high performer in terms of your overall revenue contributor, right? Sure, the margins would be picking up for electrical automation, but right now the contribution from aluminium is a tad higher. So
yeah, it's about 37-38%, and overall rest is all electronic. So I mean, it's 60-40, you can say, at approximate group level. So still,
what really changes in this quarter? How does the dynamic change in this quarter for the numbers to spring back to that double digit numbers that the company usually has registered between 16 to 20 odd %? 20% is the guidance that you've given for the financial year.
So few things. One is our these new projects which we spoke, they are settling down. This is one. Second thing is the overall top line is also expected to grow higher in the Q4. That will also add a few notches to that. And solar business is another new segment which we saw significant growth in the Q3. This is also a new one, so that also will start giving more contribution to the bottom line when we achieve certain level of volumes. So those things are going to be attributing to bottom line because of volume growth.
All right. Since you have maintained your guidance there, I'm just going to go across to other line of questions that we have. You also spoke about maximum revenue coming in first from metering control and protection devices, followed by aluminium high pressure dies. Which segment, according to you, is right now for Q4 mustering in more traction? And of course, the margin seems to be a little more attractive of the lot.
Yeah, so our industrial automation products as well as metering and control devices, these are really cash cows for us. So those revenues will be growing much higher in the Q4. They will add more contribution to the bottom line. So this is what we are expecting, and these are going to get our bottom line up by a few notches in the coming quarters.
Okay. And which one is more margin accretive at this point of time? Electrical automation, right?
Yeah, electrical automation, then test and measurement instruments, then control and measurement devices. So we have
what's the margin? The highest margin is seen where? If you can give us a split of that 8% margin profile within the product-wise breakup that you have.
Yeah, if we talk about industrial automation gross margins, we normally are we talk about in excess of 50% because these are technology-driven products, high technology. A lot of R&D investment happens in those products. then test and measurement instruments. This also, all these three product groups which we said are contribute about 50 plus kind of a gross margin level at the manufacturing level. And things like solar inverters and solar business is we talk about 15% gross margin. Then we also are adding more into EMS services, which is also like volume driven. This is also at a initial stage. So this will add about these are also low margin businesses, about 15%. When we talk about aluminum die casting, they are about 20-25% gross margin kind of businesses. So we have this mix of different portfolio. To some extent, this product portfolio also has the impact on the bottom line. So it's like we have got a lot of areas to juggle around, and that's why when we give the guidelines, we give all of those. In some quarters, some of those product lines can be more in some geographies from some companies. So overall, 18% is something which we have seen over the last decade or so, and we continue to do that. Have that, and only issue is some of the price pressures also which we have in Europe, the inflation, high inflations, and labor and energy costs going up. So these are the things which these are general challenges which we have. Of course, some of those are translated into price increases with our customers, where we design and develop our products. But some of these our portfolio in aluminum die casting, where we are kind of a contract manufacturer, where when we do a challenging projects there, so we have these are watertight contracts, so the negotiation cycles for price increases are longer. So this is where some of the price margin pressures come, but we are working on those as well.
Okay. The company plans to actually no, I'm going to ask you. The last time I spoke to the company, rather. You guys said that the company has actually set a target to achieve a revenue of 1,000 odd crore in the next 2 years. How much of that is doable now?
See, if you look at the top line, if you do 25% year on year, in 3 years you will double your revenues. When we were listed, we were just close to 600 crores. And this year we will definitely close with 25% growth on that 600 crore this. So we are going in that direction. So by 2026-27, we should be around 1,000 crores. We are pretty confident about that.
Okay. That gets delayed by a year, 26-27, because FY26 is what we were working with.
See, for next financial, our guidelines are quite similar. We will be working with, again, 20 to 25% revenue growth and about 18 to 20% EBITDA margin. So these are the guidelines which we build our strategy. We build 5-year strategy, and this is part of 5-year strategy. And year after year, we kind of tweak that and go ahead. And these increase in revenues are going to be coming by expanding our geographical regions, adding new products. So in this year so far, we have added about 6-7 new products. In the full financial, we added about 15 products. Next year, we have plans to add about 20 new products. So these are going to generate new stream of revenues into our existing market. Then we are also expanding. We have plans to expand our operations in USA and China, so which are relatively smaller entities that we have. These are set up about 10 years ago, and China was an acquisition which was done in 2019. After that, we had a prolonged COVID in China for 3 years. And now this year we saw good momentum. The revenues are going up by around 20% growth we see there this year so far. And in US also we see about 16% growth. So these are big markets where our presence is very, very small. So the plan is to expand our operations there. So those are also going to add to help achieving those 1,000 CR which we spoke about.
All right. I would want to ask a last question that I have in my mind is the company plans to explore inorganic growth prospects in larger markets and well-developed economies. That was the strategy that was laid out to me in the last interview that we've had. notably that is in United States, Brazil and Turkey. What's the update on that? Where have we reached? Have we kind of figured out few markets, any kind of companies that we're looking at? You spoke about China being the company being acquired there in the past. Would you want to dwell in more details as to what's there in the offing within these market when it comes to the inorganic growth plans? Because that's where the growth lies, right?
Yeah. Inorganic growth, we are looking at one of the acquisitions which our chairman, Mr. Nandagolia, spoke about in his last interviews. So we're looking at some acquisition in India for aluminium die casting. We are in the due diligence process on that. So that's something which we are very closely looking at because that may even help us to take some of the cost pressure that we are having in Europe on the aluminium die casting business. So that fits good for us in a strategic way to mitigate the cost challenges that we have market. We have abundant of that in Europe. So only costs are temporarily stressed, and Europe has its own plan to mitigate those costs. And if we are able to have some acquisition in Asia, particularly in India, that will help it substantially.
All right. Two follow-ups to this. What is the size of this acquisition? Which part of the geography are we talking about when it comes to India? And when can the deal be finalized?
See, it's a due diligence which is in process, and we'll inform that at appropriate time because we don't want to speculate more on that. But we had a timeline of doing it by end of this financial year. It may spill over to a quarter or something, but surely it may happen in next financial year. But these things are never complete until they are done. So it's just a process.
This financial year, right? FY24. So one can look at a time frame of April to June 2024.
Yes.
Okay. And what's the size of this acquisition?
It's about 100 CR.
In terms of the top line growth?
Yes.
Okay. All right. And also, which part of the geography are we looking at?
We said India. I mean, I don't want to speculate and give more because there are not too many die casting companies in India.
Is it a listed one? Last question on that.
No.
Okay, I'm just going to leave it on that. And thank you so much for taking out the time and having this conversation. Indeed, reassuring that the guidance has been maintained and the target is intact. But with this, it's a wrap. All right, that's the management of the Rishabh Instruments for you. Stock saw some serious amount of damage. The company has reiterated FY24 guidance of 20-25% growth on top line, 18% growth with the margins, of course, EBITDA margins at 18%, and is also confident of achieving that revenue target of nearly 1,000 crore by the next 2 years, 26-27. Also spoke about the inorganic acquisition there. 1,000 crore is what the number looks like for these for the entity, which is within India, and the deal is expected to be finalized between April to June. But that's all that we have on this edition. With this, it's a wrap, and goodbye from the team who puts this piece together for you. Thank you so much for tuning in.